think right now the risk to inflation in the U.S. is certainly to the upside.
Earnings coming in is just another data point that people have to absorb to try and understand this narrative.
There's downward pressure. The source of the negative surprises this quarter has been, in fact, weaker margins than was anticipated.
As monetary policy goes deeper into restrictive space, each incremental hike is going to be more difficult to justify.
The one thing the Fed cannot afford to have anyone say is they're not credible.
Frankly, the Fed doesn't listen, and if anything, feels more pressure to prove its independence.
This is Bloomberg Surveillance, Early Edition, with Anna Edwards, Matt Miller, and Kailey Leinz.
It's 9 a.m. in London, 5 a.m. in New York, and 5 p.m. in Hong Kong. Our top stories today. A crucial time for stock traders. 4 major events in the next 7 days could shape the market's outlook for the rest of the year. We'll have a briefing. A dramatic comeback in Brazil. Left-wing politician Luiz Inácio Lula da Silva is re-elected president 3 years after he was in jail on corruption charges. And the price of wheat soars after Russia pulls out of a deal allowing Ukrainian exports. Meanwhile, Ukraine says that Russia has launched a massive wave of missile attacks. Welcome to Bloomberg Surveillance Early Edition. I'm Anna Edwards in London with Katie Greifeld and Kailey Leinz in New York. Matt Miller is off today. And Kailey, I feel closer to you in a number of ways. We have fallen back here in Europe. You have yet to fall back in the US. So we're only separated by 4 hours. But also our market's moving pretty much in step today. European stocks move lower as US futures retreat.
Yeah, what's interesting is you didn't see a wholesale move lower in Asia overnight. It really was a bit of a mixed session. The MSCI Asia Pacific Index as a whole actually was positive on the day, rising by a little more than half of 1%. But you had stocks down in Hong Kong as well as in China, where we got some weak economic data in the form of manufacturing PMIs in contraction territory and coming up short of economist expectations. You also are in contraction territory when it comes to the services numbers, so that pointing to weakness in the Chinese economy. As a result, you are seeing a weakening in the Chinese yuan, the offshore yuan in particular, weaker against the dollar by 0.7%. We're trading at 7.32, and of course, playing into that is the PBOC setting a weaker reference rate for the yuan for the second day in a row. You also have weakness elsewhere in Asian currencies, including the Japanese yen. It is about policy divergence between the Fed, which is set to hike another 75 basis points this week, and the BOJ, which is doing nothing in the form of hiking. So as a result, dollar yen trading at 148.28. And then I wanted to point to one ETF that traded in Japan overnight as well, an ETF that tracks Brazilian assets higher by about 3.3% after Lula beat Bolsonaro in the Brazilian election. What is interesting, though, is if you take a look at pre-market trading in the U.S. and North America rather than in South America, the MSCI iShares Brazil Index, that ETF is down about 4.3% in pre-market trading. You could argue that the move in Japan was a little bit more of the follow-through from Friday's rally in Brazilian assets, Katie, but this Brazilian ETF and U.S. pre-market down more than 4%. So we'll have more on that election outcome in just a moment. But what else is going on in terms of U.S. trade?
Well, if you look at pre-market action, it's pretty risk-off. We're looking at S&P 500 futures down 0.6%. Tech futures down even more than that. This move has accelerated just in the last hour or so. It comes after a big, broad rally on Friday. The S&P 500 had rallied more than 2.5%. Taking a bit of a breather this morning. You see how that filters into the bond market. You have U.S. 10-year Treasury yields moving higher, 5 basis points or so. That was a 9 basis point move on Friday, so a continuation of the bond sell-off. And I did want to keep an eye on wheat, of course, after Russia pulled out of that grain export pact. As you would guess, wheat futures climbing as we watch here, up 6%. That move had been about 8% higher a few hours ago, Anna. Not a great sign for what's already a global food crisis.
Yeah, so we're seeing the markets respond to those geopolitical developments then, Katie, even though other parties to that agreement signed back in the summer seem to be trying to persist with it. This is the picture for European equity markets. And as Katie set out there, some weakness in U.S. futures, that's been increasingly weighing on the European story here. We tried to catch up with the gains from Friday on Wall Street, but failing to really build on those. And the FTSE down 0.1%, the CAC down 0.3. Interesting to note, the FTSE MIB is fairly flat over in Italy today. And we've just got some data, preliminary data on GDP out of Italy. Third quarter GDP GDP rising by 0.5% quarter on quarter. That is growth of 0.5%. The estimate was for that number to be entirely flat. And this is a higher number than any of the economists surveyed by Bloomberg had expected. So it just goes to show the difficulty in forecasting growth right now, and also raises really interesting questions. A lot of this was to do with the services sector, it seems, from reading some of the detail. But interesting questions nonetheless about what happens to the European growth story if the winter is milder than we had anticipated, which seems to be something that is getting a lot of attention of late. And with that in mind, we see another drop in natural gas prices here in Europe, down by another 7%. We've got natural gas prices moving in all kinds of different directions around the globe. The US story is very different. And perhaps this is a little broken now, given what we know the European Union is trying to do with this particular benchmark. But if it reflects that milder weather, that is something of a positive for the European growth story, perhaps. The euro is at 0.99. I put this in because we've got that data out of Italy, which is interesting. But also in a few, where are we? 55 minutes' time, we'll get inflation data out from the Eurozone. Will that, Kailey, come in at 10.3%? That's the estimate. The last time we got a reading of 10%. Credit Suisse up by 2%. We'll get some more details on this one. They've hired a number of banks to try and help them with the capital raising they're doing, and some confidence from one particular investor coming through in Saudi Arabia. And NatWest up by 2.3%. An example of a rally we're seeing, Kailey, today in UK banks. A lot of weekend press newspaper coverage suggesting that perhaps the government won't try to put another windfall tax on the banking sector. That is certainly what the markets are responding to today, Kailey.
All right, Anna, so certainly a lot going on in the European region, but let's get back to the story in South America, specifically Brazil. Luiz Inácio Lula da Silva has won Brazil's presidential election after narrowly beating Jair Bolsonaro in a dramatic comeback. Lula defeated the incumbent with 50.9% of the vote. He spoke after his victory.
We didn't face a candidate. We faced the machinery of the Brazilian state, put at the service of a candidate to avoid us winning the elections. Thanks to the Brazilian people, to the people who voted for me, and to the people who voted for my adversary.
Bloomberg Sherry-On is joining us now from Sao Paulo for more. She's been reporting on the election all weekend. So, Sherry, it turned out to be a very, very narrow victory for Lula. But what about Bolsonaro? Has he conceded defeat yet?
Not yet, and we're watching that very closely if the incumbent president is going to come out and accept the results. Of course, the fear is that he may not. He's repeatedly cast doubt on electoral authorities with a really narrow victory, as you say, with a margin of less than 2 percentage points. This is the narrowest presidential win in 40 years since Brazil's return to democracy. So, of course, we're watching what Bolsonaro does next. Still, we haven't heard from him, not even commenting on the results. Local media saying that he's been unavailable even to his closest allies. This did not stop Lula supporters, though, from coming out in full force in the iconic Avenida Paulista. This is one supporter telling me how he's very optimistic about the new government. Take a listen.
Today it's a great day for Brazil. Now we elected a new president that we get our expectation for new era for the next 4 years.
Congratulations have started to roll in from world leaders, including President Joe Biden, who called the election free, fair, and credible.
Well, Sherry, turning to the markets, we have some clues from the ETF world, but how are we expecting Brazilian assets to react?
I mean, they have really outperformed global peers this year. And yes, you said it, with those Brazil-related stocks trading in Asia gaining ground, perhaps we might see a pop when Brazil opens in just a few hours. Analysts saying that the victory was clear enough to give Lula the presidency, but perhaps not strong enough for the leftist president to turn more left in his economic policies. Of course, we are watching very closely what the composition of his economic team will be, and perhaps more clarity on his fiscal proposals as well, something that we did not get in his victory speech. He did say, though, that he wanted to reunite a very divided country, that he wanted to end hunger again while attracting foreign investors.
Sherry, thanks very much. Bloomberg's Sherry Ann reporting there from Sao Paulo with the latest on Brazilian politics. Let's get back to European geopolitics. And wheat surged after Russia pulled out of an agreement to allow grain exports from Ukraine through the Black Sea. A deal seemed critical for easing tight world supplies, a deal that was signed back in the summer, of course, along with the United Nations. Now, Mark Champion, our senior reporter for international affairs, joins us now with more. Mark, and it seems the market not sure how long-lasting the impact is going to be here, but from a geopolitical perspective, we are seeing some ships, it seems, still trying to carry on as if nothing had happened. What's the read across from what Russia is saying here?
Well, we need to wait and see a little bit. Obviously, it's quite a process where these ships line up, they get inspected, they go into port, they collect the grain, they come out, they get inspected, so the moment that the Russians say, we're pulling out of the deal, there's a lot of ships on the move already. So they import. And what's happening at the moment is that those that have been loaded, those that were, in port, that were past the inspection, those are coming out. And we don't really know how the Russians will react. But it may be that they're just going to let the ships that were already loaded, already in port, inspected and so on, allow those out. And then we'll see what happens next.
Well, and Mark, meanwhile, the war rages on. Ukraine saying this morning that Russia has launched a massive wave of missile strikes across the country. What's the latest there?
Yes, it was another really big set of strikes against infrastructure. You had cities without power, water disrupted, and a really, a message again. This is the second time now where the Ukrainians hit Crimea in some form. This time it was the Black Sea Fleet. And then the Russians have responded with a massive set of missile attacks. So the Russians seem to be, making a very clear point that, in their view, Crimea is off limits for this war.
Mark, thank you very much. Bloomberg's Mark Champion with the latest on that geopolitics. Let's get back to the banking sector. Credit Suisse has invited at least 20 banks to join the syndicate for a $4 billion rights issue that should help the lender finance another multi-year restructuring program. Bloomberg's Tom Metcalf joins us now with more. And Tom, good morning to you. So we heard about the restructuring last week. We heard about the capital raise last week. Now we get a sense of just how many participants there are in this and who's being asked to help. So what do we know about this rights issue?
Yeah, well, the thing that really jumps out is just how many lenders they're getting involved. At least 20. I mean, it's basically everyone on Wall Street. So, and that's for $4 billion. So that's kind of interesting. It suggests, obviously it's a very prestigious thing to join, but also perhaps that the banks are looking to spread the risk among themselves. Obviously, they would lose money if Credit Suisse shares fell any further. And then the other thing about this rights issue, of course, is that the Saudi National Bank has taken up to a third. And I think earlier today on Bloomberg, they were saying we're not going to take any more than a third. So that's kind of where we are right now.
And Tom, zooming out a little bit, how would you say this reboot overall is being received by the market?
Well, on Thursday, there was not many fans of it. It was down, I think the Credit Suisse shares down about 19%. They've recovered a little bit on Friday. But yeah, largely, I think there's a little bit of disappointment that perhaps it wasn't quite as sort of fast moving and as sweeping as people felt. So I think there's just a sense that, gosh, this might, continue for even longer than we thought.
OK, Tom, thanks very much. Bloomberg's Tom Metcalf with the latest on Credit Suisse and that particular saga. We will keep that under review. Coming up on the programme, Amanda Agati joins us, PNC Asset Management Group CIO. So much to talk about this week, from the FOMC midweek to the Bank of England on Thursday to the jobs report on Friday. And I'm sure I've forgotten 5 or 6 other things that I should have mentioned. We'll also talk about crypto, Musk's crypto push, in fact. We'll discuss what changes may be coming to the platform under the new management. Plus, we sit down exclusively with the Barclays CEO in his first TV interview since taking the helm of the UK lender. Part of that conversation ahead.
Bank liquidity, I don't think, is an issue. We've had liquidity regimes. Funding models are much, much more robust than they were in the financial crisis. I think part of what people are worried about and what they saw in the gilt market was the liquidity in underlying trading.
The markets expect another rate hike.
Investors obviously skittish.
Will the Fed do on November 2nd is key to everything.
But where will the Fed go from there?
No sign it is ready to stop tightening.
Everybody talking about a step down.
They're going to wimp out and they're going to blink.
Trust Bloomberg for the fastest coverage and exclusive analysis.
Do we want this Fed to force a recession?
The Fed's going to torpedo momentum.
In markets like this, everyone's a long-term investor.
Bloomberg Surveillance. The Fed decides. Wednesday on Bloomberg, your global business authority.
This is Bloomberg Surveillance Early Edition. I'm Katie Greifeld with Kailey Leinz in New York and Anna Edwards in London. Matt Miller is off today, and it's a heavy news week. Front and center for me is the Fed meeting on Wednesday. Let's take a look at where U.S. equity markets stand as we head into that all-important meeting. You're looking at a ratio of the S&P 500 to the tech-heavy NASDAQ. And what caught my eye is that relative to the S&P 500, it's at a pre-pandemic high relative to big tech. It's like the pandemic never even happened. As you can see, this is a trend that has been building all year, and it was this latest round of tech earnings that finally pushed us here. I want to talk about this with Justina Lee. She is a Bloomberg markets reporter. And Justina, as we count down to Wednesday, how much potential more pain could there be for big tech?
Yeah, I think that is the question right now. I mean, I still remember a few years ago when big tech stocks was considered the stabilizing force in the market, but that's really completely changed now to the point where we're actually looking to these stocks for signs of, slowing consumer demand. I think one thing that's kind of been interesting is that with that big hit from these tech earnings, investors actually haven't really been paying that much attention to kind of what bond yields mean for these tech stocks, because usually a bond rally is good for these names, but that actually has not been good enough to help these stocks last week.
Yeah, I mean, some of the corporate reporting was pretty dire, wasn't it? Not all of it, Justina, but some of it, and that seemed to be the focus. Thinking about where we go on bond markets right now, there seem to be a lot of twists and turns that could be in the way of the bond market this week. I talked to one of our colleagues on the Markets Live blog earlier who was saying you might get a dovish FOMC, and then you might get a hawkish jobs report, and that could whipsaw bond markets. What's your expectation?
Yeah, exactly. I think everyone's pretty sure that we're going to get that 75 basis point hike this week. But what everyone is paying attention to is what the Fed is going to say about, the next meeting. And we had this huge bond rally last week because people are starting to think that maybe they're going to step down the language for the December meeting. But, as we've kind of seen from the inflation reports, out of Europe, despite kind of energy prices going down and kind of with, the U.S. data that's coming out, it seems like we're not necessarily kind of, past that, inflation worry phase yet.
Yeah, and inflation, in fact, we get, Kailey, we get inflation data around the Eurozone at the top of the next hour.
Yep, and we'll be getting inflation data here in the U.S. next week, 2 days after midterm elections, so a lot of potential catalysts for this market. Justina, there was a conversation, though, that inflation was going to start to really bite corporate earnings. The pricing power was going to disappear as demand starts to fade. What is your takeaway from earnings season so far, now that we're halfway through it? Is it as bad as we were all anticipating?
I think what I read from one strategist today is that, apart from the mega cap tech, in a way, it hasn't been as bad as kind of everyone expected. Of course, it was still bad, but in the sense, maybe expectations were so low that people felt a bit of a relief, kind of, and that's why we've had this rally in the S&P 500. But I think one interesting thing this season is we've had huge reactions, to both beats and misses, and that's a sign that market is really paying attention to what, these companies are delivering.
Yeah, and it seems quite divergent, doesn't it, between individual names, Justina. Thanks so much. Bloomberg's Justina Lee with the latest on the markets. And for more market analysis, check out MLIV Go. That's the function to use on your Bloomberg terminal. That's where you find the Markets Live blog. This is Bloomberg.
This is Bloomberg Surveillance Early Edition. I'm Kailey Leinz with Katie Greifeld in New York and Anna Edwards in London. Matt Miller is off today. Now, keeping you up to date with news from around the world, here's the first word. In western India, at least 130 people were killed when a suspension bridge collapsed. The disaster happened in Prime Minister Narendra Modi's home state, Gujarat. The colonial-era bridge had been reopened last week after renovations. And in South Korea, the government has opened an investigation into one of the country's deadliest incidents in years. At least 154 people were killed when a crowd squeezed into a narrow alley during Halloween festivities in Seoul. Reports are that some people began to fall, causing others to tumble and pile onto one another. Today, there's a showdown at the U.S. Supreme Court over affirmative action. Justices will hear arguments on admissions policies at Harvard and the University of North Carolina. The schools are battling an interest group that wants to overturn precedents that let colleges consider race when they choose students. And Elon Musk is preparing for a round of job cuts at Twitter. Bloomberg has learned that the company's new owner has asked managers to draw up lists of team members who could be let go. Musk has denied reports that he plans to get rid of 75% of Twitter's 7,500 employees. So, Katie, it becomes a question of just how many people he does intend to let go and in what departments he would like to let them go from. We understand from Washington Post reporting over the weekend that maybe the ultimate number could be something more like 50%, which is still potentially thousands of Twitter employees.
Big time. And I mean, a lot of this is coming from Musk himself. We've gotten some clues from his tweets. In recent weeks, he had said that he wants to focus on the core product. You would think that includes software engineering and the like, but it's a bit of a moving target at this point, Anna. All we can do is really wait.
Yeah, absolutely. So the job cuts is one part of the story. What he wants to do with crypto, Kailey, is interesting. We'll talk more about that later on in the program. But also how advertisers respond to the new ownership. We heard from GM, of course, ahead of the weekend, and they have an interesting stance here because, of course, Kailey, you know, now we've got Musk running the show, and he, of course, runs Tesla, and so they're rethinking, and they're very close to him, I suppose, in that sense, in rival parts of the autos sector. But it'll be interesting to see how lots of businesses decide to manage this.
Well, and how regulators do as well. We've seen increasing scrutiny on social media players, especially the ownership of them. And after the attack on Paul Pelosi, the Speaker of the House, Nancy Pelosi's husband, several days ago, you have seen voices in D.C. talking about the need to police these social media companies in a better way when it comes to misinformation and conspiracy theories and the like. So the regulatory scrutiny, definitely an angle to watch. There's so many different parts of this story, and of course, we'll continue to keep track of all of it.
Yeah, a piece of corporate news with perhaps global implications. We will certainly keep on across that story. Coming up, Amanda Agati joins us, PNC Asset Management Group CIO. We'll focus in on the Fed. That's the highlight midweek, of course. What does she expect to see from the Fed itself? What does she make of the step-down narrative that the markets are dealing with right now? This is Bloomberg. This is Bloomberg Surveillance Early Edition. Here's what you need to know. A crucial time for stock traders. 4 major events in the next 7 days could shape the market's outlook for the rest of the year. We will get analysis. A dramatic comeback in Brazil. Left-wing politician Luiz Inácio Lula da Silva is re-elected president 3 years after he was in jail on corruption charges. And the price of wheat soars after Russia pulls out of a deal allowing Ukrainian exports. Meanwhile, Ukraine says Russia has launched a massive wave of missile attacks. I'm Anna Edwards in London with Katie Greifeld and Kailey Leinz in New York. Matt Miller is off today. And Katie, US futures point a little bit lower. The gains of last week, a really strong week for US stocks, of course. They seem a bit of a memory as we get ourselves ready for a busy week ahead.
Oh, big time. A distant memory. The mood music, not great in U.S. pre-market trading. We're looking at the S&P 500 futures down about 0.5%. NASDAQ futures down a little bit more to the tune of about 0.7%. This is the opposite dynamic of what we saw on Friday when big tech was really leading those gains. Maybe a bit of a breather as we count down to the big week ahead. All of this coming as the bond market continues to sell off. You're looking at 10-year Treasury yields up about 5 basis points or so, firmly above 4%. And of course, Kailey, checking in on wheat after Russia did pull out of that export pact, about 6.5% higher in an already stressed out global food supply chain.
Yeah, that's definitely something we need to keep an eye on. Now, Katie, as you said, the mood music isn't great, and a lot of that has to do with the drag created by big tech, which are broadly lower in pre-market trading when it comes to those names, including Tesla down a little more than 1%. You have Amazon down about 0.9 as well, and Apple, after a big more than 7% move to the upside on Friday after its earnings report, is giving back some of that gain, down about 0.5%. And of course, it's not just North America we have to pay attention to today. We have to pay attention to South America as well, specifically Brazil, after the results from the presidential election yesterday showed that Lula has won the election, topping Bolsonaro, although he has not yet conceded. And maybe some of the risk around that, what ultimately is going to happen, is what is dragging on Brazilian assets today. I'm measuring that in pre-market trading by taking a look at the iShares MSCI Brazil ETF. It is down about 5.25%. So definitely an asset class and really just a country to keep an eye on today and the days ahead as well, Anna.
Yeah, absolutely. We'll keep an eye on what's going on in Brazilian assets as a result. This is what's happening or not happening on European stocks right now. This Monday, we find ourselves entirely flat on the Stoxx 600. But there are two divergent stories here. There's one, energy names are moving lower. This after we got disappointing data out of China. That's weighing on the oil price, and as a result, energy names go lower. On the other side, the banking sector goes higher, and there were a couple of reasons for that. We've got NatWest Group up by just over 3%. A lot of talk over the weekend in the newspapers in the UK about whether the government will decide or not on the 17th of November in its autumn statement to go after banks for more tax raising. And it seems that the most recent thinking is that it might not. And so NatWest Group and others in the sector rally. Credit Suisse up by 2.7%. We've got a bit of a detail. Of course, we saw a real fall in this share price on Thursday, some recovery on Friday, and it's still trying to make its way back up, of course. We've heard some more detail about the capital raise there, the number of institutions that are being asked if they want to participate in it. And we've also got the euro-dollar in here. There's dollar strength is the broad theme this Monday morning, but euro weakness also part of it. And we're looking actually at some much better data coming out of the Eurozone when it comes to growth numbers. Certainly that was the case out of Germany and some other parts of the Eurozone and Italy just this morning. And we're looking ahead in half an hour's time, Katie, we're going to get inflation data. Will it come in at 10.3%, just underlining the difficult choices ahead for the ECB?
Definitely a lot to keep an eye on, even just today. But one of the big headlines this week is going to be the Fed, expected to raise interest rates by 75 basis points when it meets this Wednesday. This week's MLive poll survey asked investors how they're trading ahead of the meeting.
Right now, all central banks are playing tough and talking tough.
Investors are obviously skittish as the Fed pulls away the punch bowl of easy money, and that's going to lead to a lot of mispricing and uncertainty.
We're not only in fiscal dominance in this game of chicken between Treasury and central bank, we're in what the folks at the Bank of International Settlement call a debt trap.
It's really a Fed-driven downturn that we're seeing, and it's going to take the Fed to correct it.
Maybe the Fed could signal a move towards a smaller increments of rate hikes next week after they meet.
The labor market is still strong, but it requires a Fed that has a lot more skill and a lot more luck.
That means you need to see higher unemployment. And if that's the goal, they are failing miserably.
I think the bond vigilantes are back.
Joining us now is Amanda Agati. She is CIO at PNC Asset Management Group. Anna, or rather Amanda, it's great to have you with us this early in the morning. If the Fed delivers 75 basis points on Wednesday, it would be the fourth straight hike of that magnitude. Then if you look at market expectations, it's expected to dial back from there. But what's your expectation? Will Wednesday be peak hawkishness for this Federal Reserve?
Well, let's hope so. I think the markets and the economy can only take about as much as we have in terms of hawkishness right now here. We're definitely in the camp that we're going to get 75 basis points. Market certainly expecting that. I really continue to believe it's not necessarily about each individual Fed meeting and much more about where the terminal rate ends. Based on the current dot plot, we're looking at about 4.6%. for that terminal rate. There's never been a scenario where the Fed has been tightening through history and reached 4.6% and not tipped the economy into recession. So that's really the data point that I'm much more focused on. Are they going to revise that? And what does guidance tell us about the path forward for rates from here?
Okay, so Amanda, where would you put the likelihood of a recession at this point? And is that accurately reflected in markets?
I do think that it is to some degree accurately reflected in markets. We think we're based on where financial conditions are, where interest rates are today, that we're trading at roughly a fair value range on the S&P 500. We've been bouncing around the 15 to 17 times forward PE range. Our expectation for recession is basically a coin toss at this point. It's about 50-50 for next year, but it really comes back to the Fed being in the driver's seat. My view is that they put a really aggressive outer bound there in terms of that terminal rate, and that, between now and then we start to get a little bit of relief from some of the perfect storm macro headwinds that continue to swirl. So the Fed ultimately doesn't have to fight this inflation battle alone. The thing that really, I think, keeps me up at night is that the Fed is being forced to fight this battle, but there are a number of other forces in the backdrop that are not going to respond to higher interest rates or a tapering of the balance sheet. So the Fed needs a little bit of help in fighting this battle.
Right. The Fed can't fix supply side problems, Amanda. And also their mechanism is monetary policy. There's a fiscal policy question as well, especially with the midterms futures coming up next Tuesday. How are you thinking about political risk around that event and ultimately what the composition of Congress could mean for these markets?
So at the end of the day, there's a lot of things to keep investors up at night over, but we actually think this midterm election cycle is not one of them. I think when you look at all the different guideposts that might give us some sense of how the election is going to turn out, when you look at polling data, economic data, even market performance itself, all of those guideposts are suggesting a change in control. It doesn't necessarily mean it's a Republican sweep, but certainly a challenge of the status quo. And at the end of the day, markets really prefer gridlock because it can't really drive meaningful negative policy surprises in one direction or the other. So we'll take it in terms of a little bit less political volatility so the markets and the economy can focus on all of the other macro headwinds.
Okay, yeah, interesting to think about what the market's like here, Amanda. In terms of what you're seeing on Recession Watch, you talked there about it being a 50-50 call right now. We're getting interesting clues from the bond market. Some of that yield curve inversion has suggested to some that we're seeing clues that a recession is coming. Why are you not quite so convinced by those signals?
Well, the yield curve is definitely an important predictor in terms of the countdown to a recession, and it's been giving all kinds of mixed signals over the course of this year. The 2-year to 10-year portion of the curve has been handily in negative or inverted territory. I think at this point it's now the most inverted since 2000. So you would naturally expect to say, all right, well, a steep recession is certainly on the way, but it was only until last week where we saw the 3-month to 10-year portion of the curve invert. And so I think there's some doubt as to whether this is a false positive signal or whether this is going to be the shortest business cycle in U.S. history. I think it really comes back to the Fed being in the driver's seat. The Fed doesn't go all the way to 4.6% or potentially higher, depending on what they do with the dot plot. I think the odds of a soft landing can increase, but we just don't have great clarity on how far and how fast they're going to go from here.
And what have you made of the earnings story so far then, Amanda? A lot of people trying to explain the rally last week by looking at some of the detail of those earnings stories, all the broad strokes, and saying, you know, this is what it told us. Others saying, look, it is just about the Fed, and it's about that step down narrative. We used to call that the pivot. Now we call it step down, apparently, and how that is playing out in markets. What do you think is the role of earnings in that context?
Well, I'm an equity girl at heart, so I'm always fixated on the fundamentals and earnings season. It's always one of the 4 most wonderful times of the year for me. That being said, I think it's almost irrelevant in the context of what the Fed is or isn't going to do. I wouldn't say the earnings season has been bad per se. I'd maybe give it more of an optimistic spin and say it was mediocre at best. We definitely set a much lower bar for both revenue expectations and also earnings expectations. So far, companies are sort of beating, or by a narrow margin, kind of beating on both of those metrics, those lowered expectations. So it hasn't been great. But if I zoom out and say that's just one quarter, what does the rest of the year look like? What does 2023 look like? We're still hanging in there. We're looking at about 7% earnings growth for this year, followed up by 8% next year. So for all the talk about an economic recession, no earnings recession just yet.
No earnings recession just yet. Amanda, thank you so much for joining us. Amanda Agati, CIO at PNC Asset Management Group. No doubt we will have you back on the programme soon. Coming up on this programme, though, today, putting more crypto into Twitter, perhaps. We will discuss some of the potential changes from Elon Musk as he takes charge of the social media platform. That conversation next. This is Bloomberg.
This is Bloomberg Surveillance Early Edition. You're looking live at the Principal Room. Coming up later today, an interview with Pinterest CEO Bill Reedy. That's at 5 p.m. in New York, 10 p.m. in London. This is Bloomberg. This is Bloomberg Surveillance Early Edition. I'm Kailey Leinz with Katie Greifeld in New York and Anna Edwards in London. Matt Miller is off today. Well, after months of dramatic back and forth, Elon Musk has taken control of Twitter. And crypto Twitter is bracing for how the billionaire will put his stamp on the social media platform, with the takeover opening up possibilities for blockchain and other features. Alex Webb of Bloomberg Quick Take joins us now for more. So, Alex, before we talk about how crypto on Twitter could change under the Musk regime, what is crypto on Twitter like now? What is the stance?
Well, there's not really much payment that you can do on Twitter at the moment, but there are various sort of NFT applications. You can have verified NFT for your profile picture, for instance. But the real opportunity I think they're looking at is how to actually integrate aspects of the cryptocurrency world of tokens more deeply into the app, and particularly the payments layer.
And Alex, it's kind of impossible to know what Elon Musk is thinking. I'm not going to pretend to read his mind. We don't know his current feelings towards crypto, but we do know that crypto exchange Binance is an equity investor in this Twitter deal. What could that mean for the platform?
So it's been reported that Binance is actually building, offering a team to Twitter to help it integrate more crypto products into the platform. And the part where this starts to get interesting is we've seen Elon Musk tweet about the prospect of turning Twitter into a super app, something like Tencent. Now, the one thing that you really need to create a super app is a payments layer, is something which lets you go onto the platform and clearly pay for all the different services that they might hope to have on there. That's how WeChat works. Now, if somehow there is a world where Binance helps them build that payments layer into the platform, then it might prove to be a springboard into that super app world. Now, this is all speculation, of course, ifs, buts, maybes, could be's, possiblies, but that does seem like it might tie up.
A lot of possibles. Meanwhile, what's the broader story around Twitter as Elon Musk takes control? We hear a lot of talk about job cuts, of course. We've seen a lot of job cuts elsewhere being talked about in the tech sector, but this has a very special dynamic. He seems to want to do a whole lot more with a whole lot less people, fewer people.
But not least because he's got to find something in the order of $1.5 billion to service his debt obligations at the company per year. So at the moment, Twitter is expected to have something like $800 million in negative free cash flow this year. He needs to find a whole bunch more of that in order to keep his debt investors happy. Now, clearly, cutting headcount is the fastest way to find some capital. You also need, to your point, to find some growth in order to generate the rest of it. And whether you can do that with less is a different question. The one caveat, of course, is there's sort of a consensus among vast tracts of Silicon Valley that actually Twitter was overstaffed, given what it does. It had very low average revenue, not just per user, but average revenue per employee. And so if it can find a way of working more efficiently, then perhaps then there is an upside.
All right, Alex Webb of Bloomberg Quick Take, thank you so much. And if you want more of the crypto conversation, make sure to tune into Bloomberg Crypto on Tuesday. That's tomorrow at 1 p.m. New York time, 5 p.m. in London. Our weekly show covers the people, transactions, and technology shaping the world of decentralized finance, so don't miss it. This is Bloomberg.
This is Bloomberg Surveillance Early Edition. I'm Anna Edwards in London with Katie Greifeld and Kailey Leinz in New York. CS Venkatakrishnan, the CEO of Barclays, known as Venkat, of course, in financial circles, took over the top job a year ago after the abrupt departure of former CEO Jez Staley. Now he's leading Barclays through a war in Ukraine, rampant inflation and aggressive central bank tightening. In his first TV interview since taking the helm, Venkat spoke exclusively to Francine Lacqua on Bloomberg's Front Row.
I think the UK economy has had a lot of support during COVID, and obviously the UK has been growing more slowly than it should. But the financial services industry, which is a large part of the UK, is very competitive. But it's not the only one. Health sciences, even technology and parts of technology, fintech, are very, very bright stars in the UK. So the UK has a lot going for it, and I don't think you will see that kind of environment. I think what I'm hoping you see is what people will call a soft landing and a shallow recession, helped by the initial conditions. And so what you might see is an increase in unemployment. You might see some credit weakness among customers. but it won't be so bad that you see distress in society. However, it has to be managed carefully, and it has to be managed aggressively with a balancing of the budget, and that's what the Prime Minister has said in the last couple of days.
Are you expecting a housing crash?
I doubt it.
Talk to me a little bit about the last 6 weeks. So you mentioned the gilt. I mean, was there a moment where you were in the office thinking, like, as Barclays, you're one of course, the players in selling and buying gilts, with the margin calls coming in and saying, like, I don't know what happens in the next 2 hours?
So first of all, I think that the volatility was managed extremely well by the very effective, targeted, and time-bound actions of the Bank of England. So I think buying gilts, buying inflation-linked gilts, and then the repo facility that they put in, working with the banking system, all helped ease the pressure in the crisis. And you've got 10-year gilt yields now back below where they were at the day of the mini budget on the 23rd of September. As for us, I mean, we are large in the gilts market. What was important for us, as we saw it, was this was not a solvency issue at all for the pension system. It was a liquidity issue. And it was a liquidity issue because what was a very important feature of the UK pension system, which, by the way, I think is a good feature of the pension system, which is a matching of assets and liabilities, which employed leverage, created a liquidity problem. So a liquidity problem had to be managed. And the liquidity problem was managed by the government intervention or the Bank of England intervention, the repo facility, which allows people to borrow against assets rather than sell them, and by slowly releasing the pressure. And, so far, so good.
Do you think that will change, actually, regulations surrounding pensions in the UK?
So I don't know the answer, but I think what is important is that the UK pension system in aggregate is very well funded. It's about 125-130% funded ratio, which is extraordinarily good, which gives it a good starting point from which to manage to a less leveraged future.
Is liquidity the biggest concern for banks right now? I mean, we're again hearing, the U.S. Treasury Secretary having to do things maybe to put a bit of extra liquidity or to pad it out in the Treasury market.
So bank liquidity, I don't think is an issue. We've had liquidity regimes. Funding models are much more robust than they were in the financial crisis. I think part of what people are worried about and what they saw in the gilt market was the liquidity in underlying trading, which is that these markets are not deep with small bid offers in large sizes of trades as they used to be 15 years ago. And I think part of it, our banks are more prudent in managing their risk.
That was CS Venkatakrishnan, CEO of Barclays, speaking with Francine Lacqua on Bloomberg's Front Row. All right, now let's take a look at what is coming up for the rest of this week. OPEC will be launching its World Oil Outlook report later on today. Then on Wednesday, it is the Fed rate decision, 75 basis points, what we're expecting. Then the BOE's rate decision will come up on Thursday. And on Friday, we will get the U.S. jobs report. So very, very busy, Anna. But there are also events taking place right now today that we want to keep tabs on.
Absolutely, yeah. The Bank of England in focus later this week on monetary policy. Today it's in focus for different reasons. Lizzie Burden is outside the Bank of England for us. And Lizzie, what has happened at the Bank of England today?
Well, Anna, as you can see, the Just Stop Oil protest has reached Threadneedle Street. You can see the orange paint on the front door of the Bank of England, and it's a coordinated attack. It's also on the Home Office, the MI5 building, and the News UK building, which of course is home to the Times, the Sunday Times, Dow Jones, the Wall Street Journal newspapers. But really the message from the protesters today is that the big banks, the 60 biggest banks, have funded the fossil fuel industry to the tune of $3.8 trillion since 2016, they say, and the Bank of England specifically hasn't done enough to regulate them. That's their argument. That's what they're trying to draw attention to.
And Lizzie, quickly, is this likely to have any impact policy-wise?
Well, the climate is very much in focus at the moment in the UK because, of course, Rishi Sunak is saying he's not going to attend the COP conference because of more pressing domestic issues at home, yet Boris Johnson is attending, so pressure on him. But also he's demoted 2 climate ministers. His COP minister isn't attending cabinet. But really, as you hint, Anna, perhaps today was not the day to be doing this to the Bank of England when we've got a decision on Thursday.
Lizzie, thanks very much. Bloomberg's Lizzie Burden reporting from the Bank of England on today's climate activism. She'll also be there on Thursday to talk about monetary policy, of course. That is it for the early edition. Surveillance is up ahead. This is Bloomberg.